everybody. This is Eddie Gabor, CEO and co-founder of Key Advisors Wealth Management. I've gotten a lot of requests to send a video out to those that are not clients with what our viewpoint is on the market and where we're going to be going from here after this pretty sizable run-up we've had since March. For those of you that don't know, I'm an avid coach. I've coached youth sports for 20-some years, and I coach high school football. So these videos won't be as frequent as they were in the past because we're getting into the heart of preseason and preparing these young men to have a great season. So after my day-to-day with clients and client videos and client meetings and team meetings, the rest of my day is focused on these young men that we're trying to coach and mentor to be champions. So that's why the videos won't be as frequent here until we get done with football season. So a month and a half ago, I published a video that discussed what we got wrong because I believe in accountability, and that's the only way you're going to get better. And I talked about the fact that we were warning about a credit event coming into this year, and we got it in March when those banks failed. And what we miscalculated was the size of the, I'll call it bailout for lack of a better word, the government did when they came and backstopped all depositors. Again, just an unprecedented measure that they did. And that pretty much acted as fuel to this rally we've seen since March. In our opinion, if they didn't come in and save all those depositors, we probably would have hit new lows in the market when you look at that chart. We would have had a Fed probably stop raising rates. We would have had the recession, and then we could have started talking about a recovery. All this stimulus did, in our opinion, is just delay the inevitable. And let's talk about that and why we're still cautious. Even though we're respecting this move in the market, and I've said this on national TV, the market action has been bullish, but it is not based on fundamentals. It is all a technical move, in our opinion. And we are fundamentally based investors. Our process is data dependent on fundamentals. I have learned the hard way over the last 25 years that if you ignore fundamentals and just blindly go all in, you're going to get burned at some point in time. And I have no intention of getting our clients burned. So I am comfortable being patient. If I have to be patient for 2 years, I'll be patient for 2 years. We don't think it's going to be nearly that long. But when you have a process that you believe in and is fundamentally based like ours is, you have to have that discipline in order to execute for your clients and that big responsibility that they put on our shoulders. So let's talk about the bullish case right now, okay, and what the bulls are saying. So right now the narrative is, number one, we're going to have a soft landing, so meaning no recession, okay? Consumer strong. And third, bullish case, or at least the narrative for the bulls, is the Fed is almost done because we got a wonderful inflation print on this past print, and this battle with inflation seems to be over. We strongly disagree with all three of those points, and this is why we continue to be very cautious. Okay, so let's talk about the consumer first, all right, because this here has me pretty baffled. When we look at data, we try to look at forward-looking data, not rear-view mirror data. Okay, and make no mistake, the consumer has been much more resilient than what we thought they would be. Now, granted, some of that may have been because of the bailout we just got in March, but regardless, they've been more resilient. It's because the labor market has stayed very, very tight. But to say the consumer is strong when it is clear that when you look at excess savings, they continue to go down. Credit card debt is at an all-time high. Not to mention the amount of interest that's being charged on those credit cards. You're starting to see delinquency rates increase. You're seeing banks tighten credit. You're seeing strain on the consumer. Now, the consumer hasn't tapped out yet, but you have to look at the trend. And in our opinion, if we're seeing excess savings go down and we're seeing debt go up and we're seeing interest payments go up, and oh, by the way, these student loans that no one's paid anything on in the last 3 years are going to start to hit in September or October. Something has to give. Like, you can't just have that much debt and have new payments getting ready to come on and not expect some major headwind from a consumer perspective. So we think the consumer is going to continue to get weaker, and that's going to continue to show month over month. It'll be very interesting to hear these retail sales earnings that come out in the month of August. I think you're going to see retail traffic down. It'll be a mixed bag, I'm sure, but I think the overall consensus will be the consumer is not strong. So we strongly disagree with that, and we have the data to support it. I'm not just making something up here. So it frustrates me if someone gives me their opinion without any data. Give me the data that tells me that the consumer is strong, and I can have an educated debate with you. So we think they're weak, and they're going to get weaker, and something's going to have to give. Secondly is this whole conversation with the Fed and inflation. I think everyone expects the Fed to raise rates at least one more time next week. We're in that camp as well too. But understand this inflation print that we just got that was so celebrated by the market, one of the reasons why is from a rate of change standpoint is the base effects from June that they were comparing it to was absolute peak inflation. So of course, if you measure current inflation rates versus the peak of last June, that number is going to look pretty strong. But I think what you're going to see here is over the next several months is you're going to see inflation stay very, very sticky. And that means the Fed is not going to cut rates. The biggest thing that I worry about on the inflation front, and this is definitely, in our opinion, not priced into the market, is if we get an uptick in inflation. Take a look at oil prices. You know, people were touting the fact that energy costs came down quite a bit, and that was one of the main reasons why we saw a decrease in inflation. Well, what happens if those energy costs go back up? What happens if we're $80 a barrel in oil? And let's not forget the fact that a hot stock market is also very inflationary. And you look at housing. Housing continues to be very resilient, and prices are staying very high in housing. So you have housing staying very sticky. If energy prices continue to trend upwards, that's going to create a problem. I can't imagine a day that if we get an announcement that CPI accelerates. I'm not saying to expect that, but what I'm saying is I don't expect it to go straight down to 2%. That's what the Fed has said, and people are trying to find a reason as to why they don't believe this 2% number. But until the Fed tells us differently, why are we to think otherwise? The only way you're going to get to 2% is by getting inflation down enough that's going to be caused by a recession. All right? This whole inflation talk, again, talk to families around the country. I talk to families and businesses around the country every single week. And they laugh when we talk about inflation because they don't see it when they're going and buying groceries. Business owners aren't seeing their costs come down. So the government can give us whatever number they want. The number that I judge it off of is what the consumer is spending out of their pocket. Business owners' biggest expense for many of them is labor costs right now. Labor costs will not come down unless the unemployment number goes up. The Fed won't admit this, but they know this. This is why they're talking about the labor market. A tight labor market is extremely inflationary, and as long as labor costs stay high, the price of goods to us as the consumer are going to stay high. And the only way you're going to get those labor costs down is to see more layoffs. So we think you're going to see the weekly jobless claims trend upwards over the next 6 to 8 months. And when you get close to that 300,000 a week number is when you need to get nervous, okay? So you're going to have some weeks where they're up, some weeks that they're down. But in our opinion, you're going to see more layoffs, and the trend is going to continue over the next several months. That is not priced in to the market, in our opinion. Neither is a recession. I don't know how we get out of this problem. Everything that we try to figure out, how do we get inflation down to 2%? How do we get the labor market and labor costs down? How do we recalibrate and get things back to where we need to get to so then we can get back to a more normalized growth environment? And we continue to come to the same conclusion. And that conclusion is, in our opinion, you can't get any of these things fixed without a recession. I don't know why so many people are scared of the R word. It is normal to have cycles where you have a recession. We haven't had one in a while. We are well overdue. And in my opinion, the cost of capital is one of the biggest problems out there. So let's say the Fed doesn't raise rates one more time. They're not going to cut, in our opinion, because they're not going to cut until something breaks. But it means that these rates are going to stay higher. And you talk to business owners. Do your own due diligence. They have a tremendous amount of debt that has to get refinanced at a much higher rate. Consumers are paying a much higher rate today. This is why you look at auto loans. You're also starting to see loans being declined. So whether the bulls like it or not, credit is tightening up. These banks are not lending as much as they were. And this entire system runs on credit and debt. And you have debt levels at historic proportions, at rates we haven't seen in decades, and those lines of credit are getting tighter and tighter. Explain to me in that environment how we avoid a recession or how we're going to see an acceleration in the economy. Because I'm hearing people say we're accelerating in the economy, and it continues to cause me to scratch my head. So there are time periods where the technicals and the fundamentals don't match up. We're not going to chase. We're not going to go all in. We're going to wait until we see if our fundamental thesis plays out. If it does, we're going to get much better entry points. If it doesn't, then we'll just have to buy corrections. Now, with all that being said, what did we do in the month of June for our clients? We did put some cash to work. We sold some of our defensive names, like our treasuries, like gold, to raise cash, to buy some equities because we still wanted to keep a high money market position. We bought healthcare. We bought India. We just recently bought aerospace and defense. These are areas that we think have some good opportunity on the upside. They have easy comps to beat. They're not tied to the U.S. consumer spending, but they have a very short leash on them. We're tactical in how we manage. We're going to continue to be very tactical in how we manage them. India, we think, is a very long-term growth story. I could do a whole video on that, which I'm not. And the other sectors, we think there's natural demand there regardless of what happens here in the U.S. economy. So we're going to continue to trade this market and try to make money, but we're going to stay defensive because this market, in our opinion, is priced to perfection. And if we get anything less than perfection, in our opinion, it could lead to some sell-offs that will provide some opportunities. So we're not out of the woods yet. We need confirmation that inflation is done accelerating, and we need confirmation that we're not going into a recession. When we get those two things, we'll be in the driver's seat. Until then, we are comfortable being patient. So I hope this video helps shed some light as to why we're still cautious in the bull versus bear debate. And I can't wait until I get very bullish to match my Twitter handle of Common Sense Bull as my name. And I want to end it with this. Stan Druckenmiller, in my opinion, is one of the best investors ever stepped foot on the planet. And he said a comment, I'll paraphrase, several weeks ago. He said, not only is this the largest bubble of his career, this is the largest bubble he's ever studied. I am not going to bet against Stan Druckenmiller. So I will leave you with that to think about what he said in conjunction with the data that I just shared with you, and you come up with your own conclusion on what is best for you and your family. So thank you for your time, and I hope you make this a winning week.